Hello everybody, my name is Sean O'Leary. I'm a senior in the AIM program covering international industrials.
And my name is Bob Thelen. I am a junior in the AIM program, and I'm also covering international industrials.
Today we'll be pitching you RWE, ticker RWEOY. A little bit about our screening process. We were trying to find an emerging international renewable energies company that is trading at a fair multiple with a strong balance sheet, and we landed on RWE. Moving on to our introduction. RWE engages in the generation, transmission, and trading of electricity and is one of the largest power generation companies in Europe. It is the third largest renewable energy power generator in Europe, and its business model was transformed in 2018 when they engaged in an asset swap with the German utility E.ON. RWE acquired E.ON's renewable assets and a 16.7% stake in E.ON. E.ON received RWE's energy networks and retail business as well as a $1.77 billion cash payment. This transformed RWE's business model to focus on renewable energies in the long run. RWE operates under the segments Supply and Trading, which makes up 66.5% of the first half of 2020 revenues, Onshore Wind and Solar, which makes up 14.99%, Hydro Biomass Gas, which makes up 7.77%, Coal and Nuclear, which makes up 6.41%, and Offshore Wind, which makes up around 3%. But RWE mainly drives profitability and cash generation through renewables and gas, which makes up 65.41% of the first half of 2020 EBITDA. Revenues for RWE mainly come through the United Kingdom, which makes up 38.4% of revenues, and Germany, which makes up 36.9% of revenues. But many other countries, such as France, Italy, Spain, and the US, make up smaller portions of revenues. RWE was founded in 1898 and is headquartered in Essen, Germany. Moving on to our recommendation. RWE is number 2 in offshore wind power in the world, and as mentioned before, is Europe's third largest renewable energy power generator with over 6 gigawatts of wind and solar capacity. After the asset swap in 2018, RWE has switched its business strategy to the long-term growth in renewables. Management has already begun implementing this strategy through stating an investment between $1.7 to $2.36 billion of capex annually towards renewables to grow the capacity by 1.5 gigawatts per year at least going forward. RWE has plans to be net carbon neutral by 2040 and is fully supported and aligned with the Paris Climate Agreement, with estimates of Europe having the opportunity to add nearly 843 gigawatts of renewables capacity by 2040. As the EU governments commit to clean energy, this could require nearly $1.2 trillion in investment that RWE will be able to capitalize upon. RWE is well positioned to benefit in the shift of renewable energies and the incentives that governments are providing, the lowering of renewable energy costs driving better margins, and in the fact the renewable energy market is expected to reach over $1,512 billion by 2025, which is up from $928 billion in 2017. This represents a 6.1% CAGR in that time period. RWE recently announced a capital increase of 10% through an issuance of 61.5 million shares that resulted of about $2.36 billion in proceeds. This gives RWE adequate capital to fund new wind and solar projects to grow beyond what was originally planned in the renewable energy space. Due to the business strategy shift to renewables that RWE is focusing on, strong renewable market growth, and adequate capital to fund growth into the future, I believe that RWE should be added to the AIM International Equity Fund with a price target of 50.51, representing a 33% upside. Moving on to our drivers. Our first driver is capital increase. RWE successfully concluded an increase in shared capital of around $2.36 billion by issuing an additional 61.5 million shares. This is consistent with management's strategy to expand in the areas of renewable energies and to grow faster than initially planned. This capital increase allows for adequate funding to be able to participate in future projects. RWE is utilizing the funding already and has planned acquisition of Nordex for about $472 million. In this deal, RWE will acquire the European onshore wind and solar development platform from Nordex with a total pipeline of 2.7 gigawatts in France, Spain, Sweden, and Poland. Moving on to our second driver, carbon emission exit. RWE is committed to gradually decreasing its use of coal and lignite until it is expected to be completely depleted by 2038. It is forecasted that coal capacity and output as a total of RWE's total capacity and output will fall from 30% to 6% from 2020 to 2030, and lignite capacity and output would fall from 30% to 12% in the same period. Management is committed to decreasing its carbon footprint and is expected to spend 85% of capex on green investments going forward to drop carbon emissions 50% by 2030 and completely by 2038. The German government has launched coal tenders that are in place as well to happen throughout 2020 through 2027. And because of these, RWE will receive compensation based on how much coal they are willing to refrain from burning. Moving on to our third driver, renewable energies focus. As more countries and governments shift to renewable energies, RWE will continue to benefit. It is expected that renewables will grow from over 50% of EBITDA in 2020 to over 70% in 2023. Renewables made up just 26% of total global electricity generation in 2018. This is predicted to rise to 45% of 2040. With RWE's recent merger of E.ON Renewable Energy Resources, this will allow RWE to be well positioned to benefit from the long-term growth of renewables as governments and the world shift to a cleaner energy future. Moving on to our valuation. In order to reach an intrinsic value for RWE, a 5-year sum of parts DCF model was constructed, using a terminal growth rate of 2% and a WACC of 6.84%, along with an additional $6.33 coming from the ownership of E.ON that was discounted in a sum of parts model. An intrinsic value of 43.53 was reached. A sensitivity analysis of plus or minus 25 basis points on the terminal growth rate and plus or minus 50 basis points on the WACC produced a range from 32.12 to 65.18. Furthermore, an EV to EBITDA multiple valuation was utilized with a peer average multiple of 14.03. The result was an intrinsic value of $60.05. A price to book multiple valuation was also calculated using a weighted multiple of 2.57, resulting in an intrinsic value of $73.57. By weighting the three valuations 70, 15, 15, a price target of 50.51 was reached, which yields an upside of 33.81%. RWE has a dividend yield of 1.60%.
Moving on to risks. Some risks of RWE include strict environmental regulation, trade regulation, and a rapidly evolving industry. The European Union has some of the strictest environmental regulations in the world. RWE is currently complying with these regulations and on track with their plan for reducing reliance on CO2-emitting energy sources. In order to comply with future regulation, RWE will need to continue projects to reduce CO2 emissions in their plants. While the EU is one of the largest economies in the world, events such as Brexit show an increasingly volatile trading environment. This environment can potentially disadvantage RWE by increasing the costs and tariffs relating to the importing of raw materials and exporting of energy. The energy sector is one of the fastest evolving industries today. To adapt to new technologies, companies need to continually innovate with new technology. RWE is evolving by introducing new wind and solar technologies. Although progress is being made, new technologies are constantly being developed which RWE will need to adapt to. Moving on to management. Management consists of Dr. Rolf Martin Schmitz, who is the CEO, and Dr. Marcus Kreber, the CFO. Dr. Schmitz has been the CEO since 2016 and has been with RWE since 2009. Dr. Kreber has been the CFO since 2016 and has been with RWE since 2012.
In conclusion, we believe RWE would be a great addition to the portfolio with its focus on renewables, with outlooks of strong renewable market growth into the future, its strong capital and balance sheet, and the fact that it is trading at a discount relative to its peers. We thank everyone for listening, and we look forward to your questions on D2L and in the live Q&A on Friday.